I want to look at historical examples of stock market bubbles and their aftermaths. Historical example of stock market bubbles and their aftermaths. Number one is the Dutch Tulip Mania. The Tulip Mania is a very, very popular bubble. It happened in the 1630s. It happened in the 1630s. I think that's when this individual lost his money. This popular scientist, that he could calculate the position of the stellar bodies, but cannot calculate the behavior of men when it comes to the markets. So it is considered as one of the earliest recorded bubbles. Tulip, bulb price in the Netherlands skyrocketed due to speculative buying. Tulip is like a flower. That's it's a flower. So what was the aftermath? When price collapsed in 1937, many investors faced financial ruin. The economy, however, recovered relatively quickly due to limited systemic impact. There was no systemic impact on the economy. It only affected those people that invested in tulips. I wonder how human beings could invest in flowers. Human behavior sometimes it's very difficult to fathom how human being behaves, particularly when it comes to heart mentality. How could you be buying flowers? What for? Are you storing? Are you keeping them for storage or what? I don't really know. Anyway, they understand better. Number two is the South Sea bubble. The South Sea bubble. It happened in 1720. So shares of the South Sea company surged as investors believed in the company's promised profit from trade with South America, despite minimal actual revenue. People bought based on expectation, based on hope and faith and belief that the company will do well, So the result of trading with merchants in South America. And what was the aftermath? The bubble burst when the reality actually set in, leading to widespread losses. Many investors, including prominent politicians, were financially devastated, causing a loss in public trust in financial markets. Notable individuals invested, and the outcome was negative. Number three is the Roaring Twenties and the Great Depression. That was on 1929. So during the 1920s, stock prices in the US surged as speculative trading increased. Easy credit and high investor confidence fueled the bubble. And what was the aftermath of the crash? The crash of October 1929 wiped out billions in wealth, triggering the Great Depression, the popular Great Depression. So global economics suffered, unemployment surged, and it took years for the market to recover. If you look at the documentary about the Great Depression, you see people lining up, queuing up to buy that bread or whatsoever. It was it was terrible. It really shook the economy, the US economy. Number four is the dot-com bubble. Yeah, I could remember that one actually. That time I was like learning to, I was still learning to invest, kind of. I read about it. I all these from foreign magazines in my country we used to buy at a discount price. Old magazines, old financial magazines. We just buy them. I was reading about this the dot-com bubble. You know. Yeah, it's still vivid in my mind because people were laughing at Buffett as being old school, dinosaur, this and that cannot key into the modern economy. And yeah, I still remember. So, excessive speculation on the internet related companies led to soaring stock prices despite many companies lacking viable business model or profit. Once you just attach .com to a company, the company price will just go high. Pets.com, this one.com, xyz.com. Once it is .com, people will rush and stocks became overvalued. What was the aftermath? When the bubble burst in the early 2000s, Nasdaq lost nearly 78% of its value by 2002. 78% of its value. So many tech companies went bankrupt, but the survivors such as Amazon emerged stronger, leading to a long-term tech sector evolution. Many companies went down. I've forgotten their name, but I read about them. It was the .com to telecom bubble that time. How time flies. Please subscribe to this channel and like this video. Number five is the US housing bubble. That was precisely around 2728, 29 thereabout, but predominantly 2008. It was a global financial crisis that started from the US. So there was a surge in house prices driven by easy credit, speculative buying, and subprime mortgages. It led to an unsustainable housing market boom. Banks were just lending out money indiscriminately. Whether you are qualified or not, they will give you money to buy a house, to buy a home, even when you cannot pay. The bubble burst in 2008, triggering the global financial crisis. Major financial institutions collapsed, leading to a government bailout and long-lasting economic repercussion worldwide. I know about, I think Merrill Lynch also later named Accenture. This other bank, too, in the US, many banks were affected. Many banks were affected. And it was a worldwide event, actually, because finance is global. Many job losses, bankruptcies here and there. It had a worldwide repercussion. Number six is the cryptocurrency bubble. Cryptocurrency bubble. That is between 2007 to 2021. So in both periods, speculative favor, around cryptocurrencies like Bitcoin and Ethereum drove the price to unprecedented highs. So initial coin offerings and retail investors' enthusiasm further inflated the markets. What was the aftermath? Each boom was followed by significant correction, with many investors losing substantial capital. However, cryptocurrencies have persisted, continuing to evolve as an asset class. So in conclusion, historical stock market bubbles highlight the dangers of speculative excess, and the importance of market fundamentals. So each bubble leaves a legacy of lessons, emphasizing the need for prudent investment practices and regulatory oversight to prevent future financial crises. So be mindful of the fact that another one could be coming, could be on its way. Nobody knows. And don't follow the crowd. Don't invest in in overhyped, expensive assets